First things first, that off-cycle rate hike by the BSP last week was certainly a surprise. I'm not going to pretend that I knew about it before it happened. But what's even more surprising, after a significant 75 basis point surprise rate hike, what did the local fixed income market do? And the answer is not very much. So not really the reaction that you would have expected from, again, a significant move. So why was this the case? Simple answer, the markets had actually priced in ahead the BSP's action. Now, the timing was definitely a surprise. Our own calls, if you've been watching some of our previous webinars or research, were that the policy rate would be at around the 3% to 3.25%, so 50 to 75 basis point in hikes by year end. So all that happened was that happened a lot sooner than we were expecting it to. But in terms of magnitude, it's pretty much where we, and I guess bulk of the market, were expecting it to be. And because of that, levels prior to the rate hike had actually been pricing that in already. So when it came out, although it was a surprise, levels remained largely unchanged. They did adjust a bit higher from having rallied the previous day on Tuesday, or on Wednesday rather. But afterwards, rates actually just retraced to still stay below where they had been 2 days earlier on Tuesday. Now let's answer the second question. What about inflation? Inflation's definitely been at the top of everybody's minds, both locally and globally. And a big part of why prices have been shooting up as aggressively and consistently as they have is the global price of oil. When we moved from 5.4% in May to 6.1% inflation in June, it was largely due to the global price of oil, as well as other portions of the basket moving alongside with it even higher. We're not necessarily seeing that this July. Now, I don't want to say that we're peaking at 6.1%. I don't think that we've necessarily hit the high for the year already in terms of inflation. But I don't think that we're going to see a similar magnitude of move for inflation in July. We might see inflation kind of taper at around the 6% area. And what does that mean for the markets over the short term? Absolute yields are at decent levels already. The last time bond yields were this high was back in 2018, when inflation was close to 7% at its peak. There's a lot of value to be gained at investing in these levels. And that's why we've started to do it as well. Early in the year, we got out of the way when we saw inflation was going up. We positioned our fund strategies defensively and were able to mitigate losses. Now it's time to shift from those defensive positions into these higher yielding positions that offer longer term value. Now, you don't have to believe me when I say that we think inflation could be topping out, if not soon, then certainly by the end of the year. And if that's your poison, you can invest in the ATRAM Corporate Bond Fund, which invests and capitalizes on these higher rates by investing in corporate bonds at these levels unseen since 2018. The fund is also structured so that it minimizes volatility and is actually in a negative interest rate environment, one of the highest returning funds we have. So if you want stability and you think inflation could still keep going higher, maybe the ATRAM Corporate Bond Fund is for you. But if you choose to maybe believe us that inflation could be peaking soon, that it could be setting the stage for a reversal and a rally in the local fixed income market, then maybe the ATRAM Total Return Peso Bond Fund is for you. This fund is similarly investing in these high yields and extending duration to these longer tenor securities, given the view that inflation does top out and then reverses, setting the stage for that rally in the bond market, which will then generate positive price returns. So whichever you decide, you've got options.